Wealthy investors borrowed $138 billion against their portfolios last year instead of selling, and they paid $0 in capital gains on that money. That's according to the Federal Reserve. And it's just one of several strategies that sophisticated investors use to minimize or completely eliminate taxes on their investment gains. While most investors think the only way to access their money is to sell and pay capital gains taxes, the wealthy are playing a completely different game. Hey everyone, I'm Jeff with Proseer. We help business owners and investors keep more of what they earn. And in the next minutes, you're going to learn 6 tax strategies that the best investors use, including how that borrowing strategy actually works, why it's perfectly legal, and whether you can use it too. We're also going to cover tax loss harvesting with a real example, the 0% capital gains bracket most people don't know exists, and the $15 million tax-free gain that investors are using right now. And if you want to stay ahead on tax strategies that actually move the needle, hit that subscribe button because we break down one actionable financial strategy every single week. So let's be real. The tax code isn't designed to be fair. It's designed to incentivize certain behaviors. And when it comes to investing, the IRS has created 2 completely different tax systems for the exact same profit. Let's break it down. When you sell an investment for a profit, that's called a capital gain. The IRS splits these into 2 categories, short and long term. And the difference between them can be big. Short-term capital gains are from investments you held for 1 year or less. That's 12 months, 365 days, or fewer. These are taxed as ordinary income. That means they're added to your regular salary and taxed at your normal income tax bracket. Current federal income tax rates range from 10% all the way up to 37%. So if you're in the top tax bracket and you sell a stock after holding it for only 11 months, you're paying 37% to the IRS. Now here's where it gets interesting. Long-term capital gains are from investments held longer than 1 year. That means 366 days or more than 12 months. And these get special preferential treatment. Instead of ordinary rates, long-term gains are taxed at just 0, 15, or 20%, depending on your income. So let's do the math on a $100,000 gain. If you're in the highest tax bracket and you sell after 365 days, you pay $37,000 in federal taxes. But if you wait just 1 more day and sell at 366 days, you pay $20,000. That's a $17,000 difference for waiting 24 hours. And if you're strategic about your income level, you might pay 0. But the best investors, they're using strategies that let them avoid selling altogether. Let me show you how. There is actually a 0% long-term capital gains tax bracket. Now this only applies if you're in the lowest tax bracket and if your total income, including the capital gains, is below that threshold. So what does that mean as an example? If you're single and your total taxable income, including the capital gains in 2025 is below $96,700, you can pay absolutely 0 on your long-term capital gains. So that's a potential planning opportunity for people that have variable income from year to year. If you work with your tax team right, you could be pulling tens of thousands of dollars out of your investments tax-free if you structure it right. But the next strategy is how you can turn losses into money. This is a tactic that sophisticated investors and wealth managers use often. According to research from JP Morgan, continuous tax loss harvesting can add 1 to 2% in annual tax savings. This compounds to massive numbers over time. Here's how it works. Tax loss harvesting is a practice of selling investments that are down to offset gains from other investments that are up. The IRS lets you use capital losses to offset capital gains dollar for dollar. Plus, you can deduct up to $3,000 of losses against your ordinary income every year. Any remaining losses carry forward indefinitely to future years. Now, let me give you a real example so you can see how this works in practice. Let's say you want to be invested in the telecom sector. You bought Verizon and unfortunately, due to timing, you're down $10,000. At the same time, you hold a high-flying stock, let's say it's NVIDIA, and you're ready to take gains of $10,000. Well, if you take that $10,000, that's capital gains to you, and you could be paying taxes on that. However, here's what smart investors do. They sell the NVIDIA stock because they're ready to trade out of it, and they trigger a $10,000 gain. Then, while they like Verizon, they know that it trades pretty similarly to AT&T. So what they'll do is they'll sell that Verizon stock for that $10,000 loss, and then they'll go ahead and buy AT&T. The result is that your total capital gains are 0. The $10,000 gain in NVIDIA is offset by the $10,000 loss in Verizon, but you still have exposure to the telecom sector because you moved your investment from Verizon to AT&T. Now you have to be careful here, because there's something called the wash sale rule. According to the rules, you can't buy the same or substantially identical security within 30 days before or after your sale, or the loss will be disallowed. The key word is substantially identical. Verizon and the other telecom are in the same industry, but they're different companies with different operations and other different products. So they're not considered substantially identical. This is why the best investment advisors check portfolios daily for harvesting opportunities. Vanguard specifically recommends replacing losing investments with similar but not identical investments to stay invested while capturing the benefit of tax losses. And if you really want to buy Verizon back, you just wait 31 days and buy it again. No problem. The beauty of this strategy is it allows you to invest without worrying about short-term volatility because losses become tax assets. Now let's move on to another very powerful long-term tax strategy. This is probably the most accessible yet underutilized strategy available. According to the Investment Company Institute, Americans had $18 trillion in IRA assets alone as of mid-2025, and the number of 401k millionaires hit a record high of 595,000 accounts in 2025. Why? Because retirement accounts eliminate capital gains entirely while your money is growing. So in a traditional 401k or an IRA, you get an immediate deduction for your contribution, and your investments grow without any tax on dividends or capital gains. And you only pay ordinary income tax when you withdraw, hopefully at a lower rate in retirement. Another option is a Roth IRA, where you contribute after-tax dollars, but every dollar of growth, every dividend, every capital gain comes out completely tax-free in retirement. You could turn $50,000 into $2 million or more over 30 years and pay zero taxes on that gain. Think about it this way. If you're in the 24% tax bracket and you're able to contribute the full $23,000 to a traditional 401k this year, you just saved $5,520 in taxes immediately. And then that money grows tax deferred for decades. This is why the wealthy max out every retirement account available. Obviously, they have the money to do so, but the strategies work and they're available to everyone. So now the strategy that I mentioned at the very beginning of this video. This is the strategy that most people have never heard of, but it's exactly how the ultra wealthy access cash without triggering capital gains. It's called securities-based lending, and it's part of what's known as the buy, borrow, die strategy that billionaires use. Here's how it works. Instead of selling your appreciated investments and paying capital gains tax, you borrow against them using a securities-backed line of credit. According to the Federal Reserve, securities-based loans totaled $138 billion as of early 2024. Let's walk through a real example. Let's say you have $1 million in stock that you bought for $200,000. You're sitting on $800,000 in gains. If you sell it all to buy a house or invest in your business, you'd owe about $160,000 in capital gains taxes at a 20% rate. That's $160,000 gone to taxes. But here's what the wealthy investors do instead. They go to their brokerage, Fidelity, Schwab, JP Morgan, whoever, and they say, I want a securities-backed line of credit. According to Schwab, you can typically borrow up to 50 to 70% of your portfolio value. So on $1 million portfolio, you could get a $500,000 to $700,000 credit line. The interest rates can even be lower than most other forms of borrowing. For example, at the time of this video, Fidelity is showing rates from around 1.9 to 3.1% above SOFR, depending on the size of your line. And Schwab's current rates range from about 7.4 to 8.6%, depending on the loan amount. You only pay interest on what you actually borrow. And here's the key. Borrowed money is not taxable income. So instead of paying $160,000 in capital gains taxes, you're paying maybe $20,000 to $30,000 per year in interest on a $500,000 loan. Your investments keep growing, you keep all the upside, and you've deferred capital gains tax indefinitely. Wells Fargo specifically highlights this. You can access cash while avoiding a security sale and potentially deferring capital gains taxes. And according to FINRA, this is a legitimate strategy that allows you to avoid potential capital gains taxes because you don't have to sell securities for access to cash. Now, there are risks. If the market drops, you could face a margin call because your loan is backed by your securities. And you do need substantial assets. Most institutions require at least $100,000 in your portfolio, though Fidelity's minimum is $500,000, and it really depends on your asset manager. But for investors with significant portfolios, this is exactly how you access liquidity without triggering taxes. And when you pass away, your heirs get a step up in basis. meaning they inherit the stock at the current market value and can sell them without paying any of those accumulated capital gains. I don't need to say this, but that's the die part of buy, borrow, die. But let me show you one more powerful strategy that combines tax savings with charitable giving. If you give to charity, this is a brilliant strategy. According to research from Bank of America, 81% of affluent households made charitable contributions last year, giving an average of $33,219. But here's what separates savvy donors. They're donating appreciated stock, not cash, through donor-advised funds. Here's the magic. You contribute stock you've held long-term that's gone up in value. You get an immediate tax deduction for the full market value, up to 30% of your adjusted gross income. And you never pay capital gains tax on that appreciated stock. So you avoid capital gains tax entirely and still get the full charitable deduction. Fidelity Charitable reported granting $11.3 billion from donor-advised funds in 2023 alone. So instead of selling stock, paying 20% capital gains tax, and then donating the remaining cash, you donate the stock directly, avoid the capital gains, and get the full deduction. It's a double win. Now, the final strategy is the most powerful one, but it only works in specific situations. This is Section 1202 of the tax code, and it's wild. If you invest in qualified small business stock, meaning you buy original issuance shares of a C corporation with under $75 million in assets, and you hold it for at least 5 years, you can exclude up to 100% of your capital gains from federal income tax, up to the greater of $15 million or 10 times your original investment. Let me say that again. You could have $15 million or more in completely tax-free gains. Now, with the One Big Beautiful Bill Act signed into law in 2025, they changed the hold periods to provide tiered benefits depending on lower hold periods. For example, if you hold for 3 or 4 years, you can get some benefits, just not the full 100% exclusion. This law was designed to incentivize investments in startups, and founders, angel investors, and early employees have all saved hundreds of millions of dollars using this provision. According to the Columbia Law Review, this law can allow qualifying investors to exclude profits from all their federal taxes. Now, the requirements are specific. It has to be qualified small business stock. You must hold it for at least 3 years to get some benefits, and the company must meet certain criteria. But if you're investing in or founding a startup, you should consult with a tax advisor to make sure you structure it right from day one. So here's your action plan. First, if you're actively trading, you might want to shift to a long-term mindset. Hold investments for at least a year to get those preferential long-term rates. The difference between 37% and 20% can be massive. Second, consider if you should implement a tax loss harvesting strategy for your portfolio. Look at your portfolio and see if you have any positions that are down for the year that can offset other gains. You can sell them to capture the loss and buy a similar company in the same sector to stay invested if you're interested. Third, max out your retirement accounts, every single dollar you can. This is the easiest way to eliminate taxes on investment growth. Fourth, if you have a substantial portfolio, we're talking $1 million or more in investable assets, talk to your investment advisor about a securities-backed line of credit. This is how you can access cash for big purchases or business investments without triggering capital gains. Fifth, if you're charitably inclined and sitting on highly appreciated stock, set up a donor-advised fund or use that stock to donate directly. Don't donate cash, donate the stock. And sixth, if you're investing in or founding a startup, make absolutely certain you're structuring for QSBS qualification. The bottom line is that the best investors aren't just lucky. They know strategies that most people have never heard of. The difference between paying 37% and 15% is understanding the rules and playing strategically. These strategies, holding for long-term rates, tax loss harvesting with similar assets, maximizing retirement accounts, borrowing against your investments, using donor-advised fund or donating stock, and investing in qualified small business stock are exactly what sophisticated investors use every single day. So here's your homework. Consider if any of these strategies can apply to your portfolio and think about applying them before year end. Also, we're actively responding to any comments, so if you have a question, leave it down below. And if you found this video helpful, I'd really appreciate it if you liked and subscribed to our channel because we're sharing actionable tips every week. Thanks for watching and see you soon.